recession is defined as two consecutive quarters of, of negative GDP growth. And here are the projections uh, from Goldman Sachs in terms of GDP for Q1 and Q2, which indicated quite a severe negative GDP. And, and so really the content of this is really about getting prepared for what is likely to come. And another chart that I just added probably around 6 a.m. this morning, the Department of Labor just released the new unemployment claims for last week. And this chart basically goes back to the year 2000. And during the Great Recession of 2008, 2009, we hit 600 and at the peak 650,000 claims per week, and the highest ever recorded since they kept tracking these measures was 695,000 in October of 1982. And the week ending March 21st was 3.3 million, and last week 6.6 million. So we're 10x from the previous peak. And from there, it kind of makes you think, well, what is unemployment going to look like by summer or in the coming months? And so according to Goldman Sachs, we're going to hit about 15% unemployment by mid-year. The Federal Reserve Bank of St. Louis prediction is 32.1%. Chief economist 12%. So as you see, the numbers are, there's a lot of variation, but they're all really high, especially if you take into perspective where we've been. In February of this year, we were at 3.5%. And in the Great Recession, we hit 10% unemployment. And in the Great Depression that our great grandparents have experienced, we've hit 24.5%. So it looks like what we're going to enter is going to be really high unemployment. And with that in mind, it's like, well, what is that going to do on real estate prices? So George, actually, we'll talk about that in detail
Mhm.
throughout a little bit further. But I do believe there's great news, and I think one psychological good news or great news is that we're all in this together. And as we get out of this thing in a few months or a year, I really believe that humanity will have a little bit more compassion and empathy for one another because we're all in this together. And I believe the other great news is that the government stepped in really fast and issued a $2 trillion package, stimulus package. And today, I'm going to spend time specifically on the individual portion, the $603 billion directly directed to individuals, and also the ones for small businesses. The other great news too is that the Federal Reserve is doing absolutely all it can. They have 6 levers they can do, and they activated all 6 in the last 2 weeks of March. They dropped rates near zero. They reinitiated the quantitative easing efforts. They're injecting cash into uh, the lending environment through the repo market where they're buying mortgage-backed security. They're also now lending directly to commercial banks, which is not unusual. Typically, commercial banks lend money from private sectors or from the deposit they get from people putting their own savings there. But they basically, the Fed reduced the rate that they lend to commercial banks to create another source of funding. They're also lending cash directly to large corporations by buying their bond, their commercial paper. And lastly, they're also funding multiple central banks around the world because, as you probably know, the US currency is used throughout the world for commerce. And as these times are impacting not only our economy but the world's economy, the Fed has increased what they call their swap lines to increase the liquidity in not just our central banks, but in the rest of the world. So I truly believe, and this is what the intent is with this presentation, is what should we do um, with these, with everything that is happening? Well, first of all, I think we should stay as calm as we can and prepare as best as we can. And I think one way to reduce stress is if we can have some sort of emergency fund so we can stay financially and physically healthy. And so now I'm going to go through the $2 trillion stimulus package. But before I do, this is kind of the outline of the presentation. I will talk about the 2 trillion stimulus package. Sam will talk about different methods of creating an emergency fund along with George, and George will discuss the impact of all this on our real estate market. So the first segment I'm going to be discussing is in regards to the assistance, the relief directly to the American people through the form of the stimulus checks. These are also referred to as helicopter money, where the government is just giving checks to people to try to weather the storm. And it looks like the first, it's probably going to arrive around the 15th of this month through form of direct deposits for the ones of you that filed your tax returns. And for the ones that not, I think there's some, you can contact them and that they can actually send you a physical check. As far as the amount for single taxpayers, if you're filing for 2018 or 2019 was under 75,000, you'll receive $1,200. And if your adjusted gross income is over 99,000, you get nothing. And you get a proration if you're in between those two numbers. For head of households, that number is a little higher because of the dependents, 112. If you're under 112,500, you get $1,200. And then you get nothing if you're above basically the other number. Oh, sorry about that. For the people that are filing their tax return jointly, it's $2,400 if you're under 150,000, and then it's prorated up to 198 and nothing above 198,000. And for basically child under of the age of 16 or under, the parents will receive a $500 check per child, and there's no income qualification for that. Basically, you have a child under 16, you're going to receive the money. So now let's talk about unemployment benefits, because as we just discussed earlier, the claims are really high. There's a lot of people filing for unemployment. And part of the stimulus has what they call the pandemic unemployment compensation, which is extra on top of the regular unemployment benefit. So in California, the basic unemployment benefit calculation is that you take your highest quarter in the last 12 months, divide that by 26, and it gives you your weekly benefit up to $450 a week. On top of that, based on the stimulus, you're going to for people that are unemployed, they will receive an extra $600 per week for up to 4 months. But this program will end July 31st. So for someone, let's say, that gets unemployed at the beginning of July, they would only get 4 weeks instead of the full 4 months. There's also it's also retroactive. So if you were laid off, let's say a month ago, you can actually catch up on this past time. And there's also another stipulation that's going to give an extra 13 weeks. So typically it's a max of 26 weeks. With this unemployment stimulus, it's going to give an extra 13 weeks above and beyond the 26 weeks for a total of 39 weeks through the end of 2020. And one of the great thing about is the amount of people that can qualify is much bigger than before. So for example, part-time workers or freelancers were not able or had a really hard time getting unemployment benefits. But this really opens it up, even for gig workers like Uber drivers and so on. So it's gonna reach a lot more people that compared to the traditional unemployment benefit package. Going to Now I'm going to say a few words for business owners out there. For the ones of you that own a small business, there is also the Paycheck Protection Program, which is a $349 billion, which sounds like a ton of money, and it is. But when you factor in all the small businesses in the United States, which is around 30 million small businesses, it looks like this program will help about 30,000 of those. And this is basically a program to keep people employed, and it's for businesses for less than 500 employees. So again, it's for small businesses, even for self-employed. And the qualification is super simple: is you had to be in business in February 15th of this year, and the loan is through SBA, and it's the amount of the loan is 2.5 months your payroll expense. And if you have employees that earns in excess of $100,000 a year, the portion basically they're just going to take the first 100,000. Let's see other things. There's no fee to this loan, and one of the great things is there's a forgiveness provision. So as long as you're keeping your employees paid and on your payroll for 8 weeks, that money can be forgiven. And as long as it's been used for payroll, rent, utilities, basically they call it the payroll expenses. Guys, do you have any thoughts or questions before we roll into the forbearance? And I think Sam will jump now. We'll jump on this, right, Sam?
Well, I thought it was pretty interesting how they've allowed for self-employed individual Lyft drivers and that within the unemployment provision, which I think will help a lot of people hold on in the meantime. So I thought that was a good one to have there. And then, I know we were talking earlier, and for those of you that wanted to take advantage of this PPP program through the SBA, the Small Business Administration, the applications will start tomorrow. So since there's limited funds for it, you got to act quickly on all of this stuff and get it completed quickly. I know that when you do it, of course, things will be backed up. You'll have to wait. You'll get knocked off the server, but it's just like, just the perseverance will really help and give you peace of mind if you can get it in there, and everybody's in the same boat. So do everything that you can to get it so that we can all, weather the storm and get back. So on mortgage forbearance, Sam had a lot of thoughts on the distinctions of it. Sam, why don't you take us through, what's the good and the bad of this, and how you can get kind of in a bad position by not making your payments?
Yeah, so this is super important, and something I've been trying to get the word out to make sure that there's not a misunderstanding about what this means. The good news is that the government did write provisions into the bill that talks about forbearance on your mortgage payment for 60 days. And the good news about that is if you do have to take advantage of that, it's without fees, it's without penalties, it's without interest on the interest, and it's without getting your credit damage. So these are good things. And the biggest thing I've been telling people is we don't want to confuse forbearance with forgiveness. And what I mean by that is forbearance simply means that you can stop making your payments if you need to. And I'm going to give advice on how to make sure you know exactly what to do in your particular situation. But you can stop making payments. As an example, if your mortgage payment's $2,000 a month, you can stop making payments for up to 180 days, and it can actually be another 180 days if you qualify and request. But let's just talk about a 6-month example. You can stop making payments for up to 6 months. So that's $12,000 of forbearance. And what forbearance means is, and the technical definition is, that $12,000 becomes due after that 6th month. So the first step is it's required to be paid at the 6 months. So all $12,000. Now, if you can't make the payment after the 6th month of forbearance, then the servicer is going to go through and cascade down through a waterfall of what we call loss mitigation examples. So when you start to go through loss mitigation waterfalls, now you're starting to deal with loan modifications. You're starting to deal with potentially spreading that $12,000 out over a certain number of months. You're starting to talk about, like I said, loan modifications, and there's definitely waterfalls of what loss mitigation means, and that has consequences. That potentially has consequences of your credit score, credit defaults, your ability to get future credit in a market where I believe interest rates are going to go to historic lows for us to take advantage of. So, you know, the best thing to do, if you need to preserve cash and you need to have this mortgage forbearance, and I believe this should be one of the last resorts, but if you need it, you make sure you call your servicer and you understand and are very, very clear from the servicer that is servicing your loan what it all means, what they're going to do, how they're going to do it when the forbearance period is over, what they're going to do if you can't make the payment after the forbearance period is over. It's really, servicers are really trying to get guidance from federal agencies and governments to really make sure they do this properly, because there wasn't a whole lot of detail put out in the stimulus bill. So there's a lot of questions, but in general, the forbearance is not forgiveness. And that's the most important thing to remember. So there might be some banks that service loans where they do allow it to be what's called a deferment, where you miss 3, 4, 6 months of payments, and then they actually add it on to the back of the loan, and your 30-year term actually extends until that forbearance or that deferred amount is paid off. So that could be possible. So the most important thing is to make sure you understand the impact of what this might have from a consequential standpoint later, when we believe that we're going to go into a market where there's going to be a lot of opportunity to take advantage of savings. There's going to be a lot of opportunity to refinance at lower rates, potentially consolidate debt at lower rates and increase your cash flow. So just make sure you understand exactly what this means for your particular loan from your servicer.
I've got a comment on this from being through the, you know, I've been doing it for a lot of years, and being through this, you know, we all thought that back in 2008, 9, 10, that we'd all get loan mods, but there was always a catch, Sam. It's like, no, your loan wasn't this one, your loan's this one. Oh no, you're current on your payment, you don't qualify for this program. Then you go late. Oh no, that's been discontinued. You're late. You would have had to been current with no lates for 6 months. So what Sam is saying is so true. There's really a lot of rules to it, and it's dynamic and changing. So us as consumers, we assume whatever, hey, we're getting our loan deferred, and so we won't have to pay it back. They'll add it to the back of the loan. We'll be good. We'll have no payments for a few months. But he's saying you could have a bill of whatever you didn't pay due the next month. And then he said loss mitigation trees, or I can't remember what it was exactly.
It's loss mitigation waterfalls. It starts to cascade down through a waterfall of
loss
mitigation techniques.
And that's kind of a nightmare, because if you can avoid that, avoid that. If you can't, then take every step to have it added at the back of the loan, and know that whatever programs are out there, you know, there's always rules to them. And having like a professional like Sam that can look at your loan, talk you through it, and say, hey, you know, this is probably a better option for you. Because honestly, things that you and I that do things every day, we don't even know the loans. And imagine the consumer that got a loan 5, 6 years ago or did a refi, they don't know these specific things. So it's just so important to get the details, because what you think is right, you know, there may be a catch to it.
Great advice.
Yeah.
And it's really important to call your servicer. It really depends on them. I mean, when you think of the different parts of our industry, the servicer is required to collect the payments from the consumer and deal with any issues and pay property taxes and insurance and, you know, deal with questions and problems. And the servicer is required to make the payments to the investor. The investor is the end person who actually bought the loan and owns the loan and is earning the interest. And when the consumer doesn't pay, by covenants and contracts, the servicer is still required to pay. So that's why it's really important to understand from your servicer, their covenants, their contracts, who is actually the investor on your loan, how are they allowing it to happen per the stimulus bill and in this particular crisis. And there's so many, it's very, very complex. They made it look very simple when it just said, hey, you can stop making your payments for up to 180 days. But really find out the consequences of that, because it can have some. And I, you know, if you look as a whole, we have as a country have more equity in our homes right now than ever before. And my biggest message is we got to protect that equity, and you don't want to dig yourself into a hole that you potentially might not be able to get out of. And I think that's the most important thing to remember.
Yeah, good advice. And so what would you think? So cash out refinance, a HELOC, what's the difference of those, Sam? And what do you think is most appropriate? And does it easier to qualify for one than the other? And is one cheaper?
Yes, so a cash out refinance, let's talk about that real fast. That is a way to actually tap into the equity of your home that I was just talking about. That's where you would take your existing loan and you would refinance it with a new loan that is higher than the payoff of your existing loan, and the difference in that would come to you in cash. That's just a very, very standard loan. And the good news in today's environment is the federal government and the agencies that they back have made it very, very clear that they're going to keep funding. They're going to keep this liquidity in this market, which is a very good thing. The one area we have to be careful of is the federal agencies will only lend up to a certain amount in your areas. And then we get what we call it, we get into the jumbo market. The jumbo market is almost all pretty much frozen. It's very, very difficult right now to get a jumbo loan. So we want to be careful when we go above the conforming limit in your area. But for the most part, you can get a cash out refinance. And like I said, that's a way to tap in and utilize the equity of your home and get through, you know, an environment like we're in today.
Sam, what is the conforming limit for San Diego County?
So for San Diego County, it is 701,500.
Okay.
So if somebody has a $400,000 loan right now, they could do a $600,000 loan if they qualify, and they can take that $200,000 in cash and have that as reserves and make sure that's part of their emergency fund. I mean, I was an example. You might not need that much. You know, I just want to make sure that people understand the consequences, how much their payment's going to go up, you know, how does that affect their personal budgets and things like that. So make sure you look at the whole picture. A home equity line of credit is where you keep your first loan, what we call your first loan or your existing mortgage, and you go to a bank and you get what's called a stand-alone home equity line of credit, which is a second mortgage behind your first. Currently, that is where the government dropping the rates to almost 0% helped, because the home equity lines of credit are variable and they're based on the Fed funds rate. So in this particular environment, the rates are going to be fairly good as our economy picks back up, and as you know, we start to move forward, and the federal government starts to raise that rate. It does start to rise, and it can rise monthly. So it's one thing you got to be careful of how much can that thing go up and how fast can it go up. But it is a way to tap into your the equity of your home. You can get one, and you don't even have to draw from it, which means you're not paying on interest that you didn't take yet, and you can have it there as an emergency. So that's something to remember from a home equity line of credit standpoint.
So Sam, on that, as part of the stimulus or as this changing and helping people out, is there going to be changes either on the refinance, on the qualifications of people, or on the home equity line? What if you have an equity line, you have a lot of equity, and you want more, so you want to pay off that second? So how do they look at, I guess one question would be, is there different criteria that they're adding to qualify people for a refinance? That's one thing. And then number two is the HELOC easier for people to qualify for? And if you have an existing second on your house, but plenty of equity, are you able to pay that off and refinance with the other one? Is that harder to qualify or easier than the full refi?
So in today's environment, in general, so let's talk about guidelines in general. There's a lot of different types of programs, a lot of different banks, and they all have small variations in guidelines. But in general, it's the same type of qualification, even to add a home equity line of credit to your home behind your first mortgage, meaning the lender has to look and calculate your ability to repay, looking at your income, looking at your other expenses, and make sure that it fits guidelines that fit what we call the ability to repay guidelines that were put in place in 2010-ish in the Dodd-Frank era. So in general, it's the same type of qualification. They're going to look at the same loan to value ratios of your house. Typically, a home equity line of credit will allow you to go up a little bit higher in loan to value ratios than a cash out mortgage. So that's actually a positive from a home equity line of credit. And your second question is, there are no prepayment penalties. Typically, there are no prepayment penalties if you do want to pay off your second mortgage. If that was the question, George, you can pay it off. Sometimes banks do have a $200 or $300 early closure fee just from a servicing standpoint, but in general, it's you can pay them off, and typically all of first mortgages today don't have prepayment penalties either. But I will say that in this environment of uncertainty and a little bit of fear and this thought, if you're a mortgage servicer or you're an investor that's getting payments for the money that you lent people, and you're worried about people not making their payments, it does make the lending industry starting to tighten up, where they might want to lower the debt to income ratio guideline. They might lower the loan to value ratio of how much you can borrow. In 2010 and 11, and I don't think this is going to happen this time, but in 2010 and 11, when we entered the Great Recession, banks froze home equity lines of credit. So there were people that, if you really needed some cash, you needed to take that before they froze your line of credit. And the reason is because in that era, home values were dropping very, very quickly. We don't see that in this particular environment. George is going to talk about that. But you got to remember, in 2008, that crisis was caused by the lending world in general. This crisis is caused by something completely separate. And we are at a point where I would call it the most solid ground in the housing market, where our home values are solid, the supply and demand is solid, our equity positions is solid. All the loans underlying this particular real estate market are rock solid. So we're entering a completely different type of time frame in this particular crisis than the last one. I think it's important to make that distinction of last one and this one.
No, I agree with that. And I know we're going to get into some other things about tapping into a retirement account, but between the home equity line and I've seen like private lenders offering seconds or equity lines, what's your position on that, Sam? And have you seen that? And I guess if that's somewhere between getting a private lender and getting a credit card advance, they're probably cheaper doing the private lender.
Oh, the home equity line of credit is going to be much, much cheaper than a private lender or credit cards for sure. If you have a current first mortgage at a very, very low rate and you can qualify for a home equity line of credit and you can have it sitting there as your emergency fund without paying interest on it, I think that's a smart thing to do. I do think also, taking a cash out as a first mortgage and consolidating debt and creating some emergency fund is a really good thing to do. I mean, we have clients that will pay off debt from a cash out refinance, and they may improve their cash flow $2,000, $3,000, and $4,000 a month, and really create a lot of savings. And part of the questions we get is, well, yeah, if we do that, we're spreading debt over the 30 more years. And it says, well, if you just take half of the savings and make that extra payment, here's how much money you would save, and here's how much earlier you would pay your loan off, from 30 years to 20 years as an example. So it's really important to look at the math and not let emotion make your decisions. Let's let math help make our decisions.
Yeah, no, that's great advice.
So Sam, can you talk about this aspect of the stimulus package? That's another source of emergency fund. People can now access the retirement account without paying the penalty, and if they're not under the age requirement.
Yes. So there's a provision in the bill that allows you to withdraw money from your pre-tax accounts, your 401ks, your IRAs, without having the 10% penalty if you are younger than the retirement age. I think the important thing here is I don't want people to think that, oh, I can take my retirement out and I don't have to pay taxes. That's something you want to, consult your tax advisor. What does it mean? What tax bracket am I in? How much is it going to cost me to withdraw this money? But what they did that's clear is that the penalty of 10% if you wanted to withdraw it early is eliminated in this bill. And I'm not sure the time period, Paul, if you do, but I don't know how much time you have to do that if you really wanted to use that as an emergency fund.
It has to be done through the end of the year.
Okay.
Before the end of the year.
Okay.
So Sam, are you saying you likely will still have taxes, you just won't have the penalty?
Absolutely. And I'm not a tax expert, but the way I read it is that you won't have the penalty, but I'm almost certain, and that's why I would consult your tax advisor, that you're still going to have to pay taxes in whatever tax bracket, progressive tax bracket you're in, for that money that you're withdrawing.
Yeah, makes sense.
I mean, this one's interesting to me. I mean, if it was, without the penalty, or let's say it was without taxes, well, that's a lot of money that would be sucked out of the system and put into people's personal bank accounts, which I think would cause, and this could actually cause some unintended consequences also. But the government has made it very, very clear that they are willing to print as much money and put as much liquidity in the system until this crisis passes as possible. So I think we're in pretty safe territory there. Okay, so a fourth one is, credit cards. If people have credit cards, if you want to try and preserve some cash and just make sure you get through the next few months, you can start paying some of your expenses with your credit card. The last resort is to take cash off them, because that comes with fees, that comes with higher interest rates. So my advice would be, if you need to start using a little bit of your credit cards, or just using your credit cards, make sure you actually pay expenses with them and preserve the cash that you otherwise would have spent on those, and not going in and taking cash off those cards. Because like I said, it's typically a much higher interest rate, and it comes with fees. And if you can, try to keep your balance of your credit available to credit used below 30%. That's going to keep your credit score at its highest point. If you got to go above that, try and stay below 50%. Because the utilization of credit, how much credit's available to you and how much you're actually using, is 35% of your credit score. So it can have a pretty tremendous effect on your score in an area where I believe in the next 3, 4, 5, 6 months, we're going to go into incredibly low interest rates. I don't have a crystal ball, but my opinion is we're going to have an incredible opportunity to save America money. And, I believe we're going to, your interest rate will begin with a 2 at some point in the next year.
Excellent. All right, so creating an emergency fund, a very simple one is the sale of a property or other assets. Most of us who live in our house, we've got all this going on, we don't necessarily want to sell, but let's look at some of the impact that we're seeing in the housing market. And let's roll into that next slide. Yeah. So what's the impact on real estate here in San Diego? So as you can see here on this chart, the beginning of March, before all this happened, we had 86 canceled and withdrawn properties. We got it highlighted there in yellow. And then you can see after this all went down last week, we had 231 canceled and withdrawn properties. At the same time, look at that top line where we have active properties for that first week of March. And I mean, we're right in the hot selling season, 395 on the market. So that's new homes that came on the market out of about 6,000 homes here in San Diego that are currently on the market. So 395 new ones came on. And then look at last week, 557 came on. So we're seeing an increasing supply of properties coming on the market. Same time, you can see that the pending, that next line under, that's decreased as well. So I think we're going to see more supply longer term on the market. So let's take a look at how that's going to impact. Here's some of my thoughts. So if you've been thinking about putting your home on the market, and a lot of people have, some have pulled it off because of, they're very worried about stuff, but we're in a new world. And still people every day are having to sell and people are buying. We still are putting properties into contract every single day. but how do we do it safely? Particularly, we had, a couple weeks ago, we were deemed a non-essential business. Since then, we've been able to show property on a limited basis, taking every safety precaution. So on this marketing and exposure, that limits your exposure through systems like virtual tours, through systems like Matterport, which is this awesome software where we go through and it's a 3D camera, and it takes, for a 2,000 square foot home, takes several hours to do, and the buyer can walk through, they can turn around, they can look at every corner like you're doing a virtual walkthrough. And again, the video walkthrough that we're doing with customers to make sure that we're qualifying people prior to seeing the property, their motivation, their timing, their financial ability, so that we lessen any sort of exposure to any of our sellers. Let's look at the next slide. So how do we take the safety? This is a big thing. We have some clients that are more concerned and some are less concerned, both on the buyer and the seller side. But what we've done is taken safe protocols to provide gloves and masks and hand sanitizer. So for example, we go in, we qualify them that they want to see it, that it's the right fit, do the virtual tour, do the walkthrough, do the Matterport. Then we establish a time. We don't want a bunch of people coming through the property. So we arrive early, we have this whole setup, our hand washing station, we have our gloves, and then we open all the doors and all the closets to limit any of the buyers coming through and touching the surfaces for the clients. And then we show it, typically we're showing it at a safe distance from the other client, the other agent's client, when we're selling properties, when we're listing them, so that everybody stays safe. We go through at the end, we use Clorox wipes, we go through, we clean all the surfaces to really limit any sort of exposure. And similarly on vacant properties, we have one that, well, let's go to the next slide. All right, so here's some of the selling protocols that we do. All the contracts, the forms, the disclosures are all done electronically on DocuSign. We're doing client meetings on, such as this, on Zoom. No public open houses, that's frowned upon. And then we're following all the rules for tenant occupied properties. All the regulations, the standards to respect their rights. Let's go to the next slide.
George, speaking of tenant properties, tenant occupied properties,
yeah.
If I'm not mistaken, there's been a ban on evictions, right? Can you maybe talk about people on the line that that have rental properties and how this crisis may impact them?
That's a big issue for people. So what we've had is they're stopping any of the evictions through May preliminarily. And so if people, aren't able to pay rent, landlords are disadvantaged because obviously they can't evict anybody and they very often have a mortgage payment and they're not receiving rent on it. We've seen that, and even prior to the whole coronavirus, we had so many of the rent controls, at the end of last year, where there was a certain amount you could raise the rent, different tenants' rights. So as a home, a rental property owner or income property owner, you're facing a lot of factors coming towards you, probably more supply on the market. You're facing maybe a price decrease. After last 10 years, we've seen between 6 and 10% appreciation year after year after year. I guess the bottom line is it's harder to be a landlord in where you're still having the outflow of expenses and not getting your rents. It might be an opportune time to liquidate or sell that property. And the great news on it is real estate market moves so much slower than the stock market. So you still have time to get that equity out before there's any sort of decline on the pricing. And so we're really seeing that as a lot of risk. This slide here, we're looking at increasing the certainty of selling. So in a market, we've all been through, we're all very experienced on this panel here, and we've all seen a market, and we know that when there's uncertainty, that's not good for the market, whether it's the home buyer getting nervous, where it's the home seller wanting to pull it off the market, or it's the investors from the lenders not wanting to make the loans. So the quicker we can get that loan funded or get that property closed before the seller changes their mind and pulls it off the market, or the buyer does, to increase our certainty of selling and having less of a fallout rate, we do a pre-home inspection. where we go through, and a lot of times where people are uncertain, any property defect might cause them to cancel the escrow and just leave. So what we've done here is we do a pre-home inspection and have the owner address any of those items prior to coming on the market, so it's as clean as possible and makes it as smooth a sale as possible.
So that's basically to help the seller with the likelihood of actually getting the home sold once they open
Right.
escrow.
Yeah, and Paul, that's exactly right. And again, what we're seeing is the longer in any market, and particularly the next few months moving forward, in any market, the longer your home sets on the market, the lower price you're likely to get. So by us doing a pre-home inspection and solving any problems when the buyer does their home inspection, it'll be clean as a whistle and it'll be much smoother escrow. That's another pitfall we can avoid. Then our showing monitoring system. This is what we do. Right now we're doing a transaction where we have a showing monitoring system. It's a vacant property. And since we're having less face-to-face showings, and when the home inspectors go in, we want to know what they're doing, what time they're going. We have our showing monitoring system. And the cool thing is in real time, once the door's opened, it starts and it sends you a text on your app to go and look at it. And then you can view the showing, the home inspection, and we can as well. So we really keep an eye on any of our vacant properties and also our occupied properties to make sure that every protocol is followed. And it gives sellers a great peace of mind, and it's just an additional service to really stay on top of it.
That's cool. It really gives the ability to the owner to know what's going on in their house while they're not there, especially in light of these new protocols.
Absolutely. And people love it. People love being informed. People love being updated on it. So I really appreciate, everybody being here. And, I appreciate Sam and I appreciate Paul. And they've been kind enough to give us their contact information and their cell phone. So if you have a specific question for them, reach out to them. Now, for me, anybody I can help with, it's you may have specifics on your situation, and we want to help give you guidance to get you through. And if you have been thinking about selling, over the past years, the equity is really at an all-time high, like Sam was saying. And particularly if it's a rental property and you've got a lot of the tenant issues that are starting to really impact you as a homeowner, and you want to get the top price, you've been thinking about it for a while, now may be a very opportune time to get it on the market while your equity is still high and the prices are still high. So if I can help with anything, just reach out to me and I'd love to help. Now let's open it up for questions, see what we have. Okay, so looks like I got one here for Sam. So Sam, the question here is, they've seen the interest rates go up since all of this has been happening. And can you talk a little bit about what's going on? Why would interest rates go up when the Fed has cut the mortgage rates? And it seems like, I know a lot of time the stock market going down means the mortgage rates go down. So what's going on?
Yeah, so it's interesting. So the biggest question that happens is when the federal government lowers the Fed funds rate, everybody thinks that means that the mortgage rates go down. And the Fed's funds rate is not tied to mortgage rates at all. Mortgage rates are tied to mortgage-backed security prices. And so that is what drives our rates. Now, there's something very, very unique in this particular environment that I personally have not seen before. And that is where what I would call interest rates are artificially high. Our rate sheets, the rates we can offer to the public are dislocated from the actual mortgage-backed security price. And there's a few reasons why. The first reason is uncertainty. If investors are worried about investing in mortgages and worried about if people are going to be employed and worried about if people are going to make their payments, there's going to be less demand to buy the mortgages, which means interest rates have to rise to draw those people in to buy those mortgages. So even though the mortgage-backed security price is very, very good right now, I mean, it's the best I've ever seen it. Interest rates should be 3% or even lower, but like I said, rate sheets are artificially high, mostly because of uncertainty about what's going to transpire. And the second reason is it was almost a perfect storm. Right before the coronavirus actually came in and hit, interest rates were going to historic lows, and our industry was taking in more volume than we've ever taken in history. So basically, we hit over 100% capacity as an industry, and then the coronavirus came in, and all that volatility caused the mortgage-backed prices we can offer to the consumer to be dislocated from the actual price it should be. So it's capacity of mortgage companies, it's uncertainty. There's some more complicated things when it comes to hedging risk from a mortgage as a mortgage company. When we promise a rate to a consumer, for an example of 45 days, that is the mortgage company's promise to give you that rate. That rate and that mortgage company we don't actually deliver that loan to the market until 45 days later, until after it funds. So the mortgage company has risk in rates going up or down. So they have to mitigate that risk. And one of the ways they mitigate that risk is called hedging. So as an example, if we lock in a rate and the rates actually go higher, there's financial instruments where they hedge, and they hedge mortgage-backed securities or short them, and the extra profits from the short that they hedged with their broker dealers actually ties your rate down to what we promised it would. So that's an example. But these hedging mechanisms, when we had record volume coming in, and then the coronavirus comes in, and really unique and unprecedented volatility in all markets, mortgage-backed security markets, stock markets, everything was not acting normal. And there was a lot of uncertainty and a lot of fear, and it actually cost the mortgage companies a lot of money, what happened to pay those broker dealers for those hedges. So it really caused a fear, and so mortgage companies had to raise rates in order to protect themselves in this volatile market. So my advice to people right now is, on a refinance situation, interest rates are artificially high. So what do? You call a mortgage lender, call your lender, call me, call my team, and you get prepared for when the wave gets through and the certain comes back. Interest rates are going to go, in my opinion, to historic lows. So you have to be prepared. You have to be more prepared than the person next to you, which means having your complete application in and updated, all the documents the lender needs ready, so that our finger is literally on the button, on the trigger to lock once we hit historically low rates. So that's the best advice right now, because the capacity wave will get through, the certainty will start coming back, the fear of this virus will pass, and we're going to enter a market that we've never seen before, and I believe there's going to be a lot of opportunity to take advantage of that rate. But right now, I recommend to everyone that calls right now, I'm not refinancing them, because the interest rate it's artificially high, and it's going to go down to where it should be. And so we really need to be prepared for that when it does.
So when you say artificially high, if I went out looking for it, I'd get about a 4% right now.
Correct.
Is that right?
Some companies might be at 4.5, some might be at 4,
Yeah.
but the mortgage-backed price in normal times should be 3. So it's really crazy, and I've never seen it before, but it's definitely something that, and it's really interesting if you see the way the market's pricing these. If you're a servicer and you pay, 1% for the opportunity to service that loan, and you make a third of that back per year, it's a 3-year break-even point before a servicer even starts making money. So if they know that the market's artificially high, and they know that that might just be refinanced in the next 6 months, now they're not going to buy it. So it's feeding itself. So
Right.
So that's why we just need to be very watchful. We need to be prepared. You need to have your application in. You need to have your documents in, because there's going to be about 8 trillion of mortgage debt wanting to be refinanced or purchase money, and our industry has capacity for about 2 to 2.5. So if you just do the math, there's going to be a long line. So be prepared. Make sure you're prepared.
Okay, well, thank you, Sam. And then Paul, I got a question for you. It looks like, how quickly do you think we'll get over this? We've been seeing that V curve, which is like going down and up pretty quick. Do you see that here, or what do you see like long term? Because you did more of the macroeconomic stuff.
No, how can I say? I would say I like that we're all independent thinkers on this call, and Sam shared his opinion, which is kind of like the V thing, the V curve.
Mm-hmm.
I have a hard time seeing that. I believe with these really high unemployment rate we're going to hit, it's going to drop home buying demand. And just on the qualification standpoint, it's going to take a lot of prospective buyer out. But even on the psychological standpoint, like even for the ones that can still qualify, may still choose to wait to see how the dust settles before they make the biggest commitment of their life, or one of them, which is buying a house. So I think the recovery will be a gradual thing. I don't see, like right now we're falling like a rock off a cliff. I don't think we're going to see bouncing down like a trampoline. I think we're going to see, gradual growth as people become more comfortable getting in proximity, as people become more comfortable with their financial security. Like if we talk, and I think to me it also is sector dependent. Like the pizza shop at the corner of the street, we'll see a bounce back, I think, pretty quickly because it's a low commitment. Like, okay, I go spend $50 on a couple pizzas. It's one thing, but buying a house, that's a very different level of commitment. So as far as the real estate industry goes, I believe our curve it's not going to be a V. It's going to be a gradual growth as the overall sentiment and confidence in the market increases.
Yeah, that's interesting. One thing, Sam had said something about the equity. So here's two things that I think will help on a recovery and getting back. And I do have an optimistic perspective, maybe because I've been doing this a long time. I've been through this and I've seen it. But from my perspective, I think that two things saving us is, number one, people have hundreds of thousands of dollars in equity. And I see that on a lot of people that we represent. And so when things get a little squirrely and prices soften up, people get resistant. And they're doing this because they want these options to move to a different home, do this thing. So I'm seeing as many of the properties pulling off the market because of coronavirus safety issues on the value. So I see that inventory reducing. And I also see the number of buyers getting scared too. And I look at going from 3 to 4 offers per house versus 1. So I think we would have to realize that this is an unprecedented time, and there's going to be an effect on the real estate economy. And the two things keeping it from, I think, getting real bad is the low interest rate and then people with tons of equity. And I guess the third one is the lack of a huge inventory that people are just going to be walking from it. And, I can maybe see with the jumbo loan rates that not solving that problem. I know some of the portfolio lenders and some of the credit unions are doing up to $2.5 million with favorable loan terms. So you have to go a different area to find those options. But I think we have to figure that out, because if one price point stalls, I think the rest of it will stall. So I think, like Sam said, we have to have a lot of the liquidity in the market to keep things going. But I agree with Paul that there will be an impact. We don't know how quickly we'll get out of this, but I do think that if we all put a plan together and we can survive, weather the storm like we had on this webinar, I think, I think we'll all be okay, and we just keep supporting each other and, know that we've all been through it. We all can all help you, and just reach out to us.
Any other questions?
I think that's it.
All right. Well,
thank you.
Thank you everyone on the call.
Thank
And
you, guys.
you guys are safe and sound, and thank you guys.
Okay, take care.
Bye-bye.
Okay,
Bye.
bye-bye.